Welcome to my daily channel. Today we're going to go over Adyen and have a closer look at more of the qualitative factors in our fundamental analysis of the stock. So the goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. If that sounds good, subscribe to come along. Who am I? I'm Jack. I'm an individual investor on the journey. I'm just 2,500 hours in over the last 7 years. I'm sharing what I learned along the way. Now, I've gone over how I came across this stock. It ended up popping up in a screen, looking at sort of smaller cap stocks, as well as that had reasonably high return on invested capital, high profit margins, and things like that. Now, I have done a 5-minute check. The business was worth looking into further, so that's what I've done. Now I'm doing my homework to then be able to come up with a valuation for the business. These are the guys I learned off. They did pretty well for themselves over just a little while. And by following the breadcrumbs they've left behind, I want to be able to follow in their footsteps. So I've pulled together a heap of free resources for you guys so that you guys don't have to start from scratch. And it's built from the lessons that I've learned from those guys and what I've learned along my way as well. Now, if you want anything along those lines, as well as, I guess, the calculator or a version of it that we'll be using in the video today, you can check that out. Link in the description. It's free, my gift to you guys. Otherwise, let's jump into it. So today, we'll be going over the annual report. But first, yesterday I went over some challenges that I was having with the financials for Adyen. And so we'll just go over those quickly and kind of tie a bow in that one. So I had the CapEx figures for the last 5 years, but what I didn't have was the cash from operations was all over the shop. And really it was inflated with some other terms that were in there. And so what I ended up doing was going into each one of these reports and then having to remove, it was the receivables from merchants and financial institutions. And then there was also payables to merchants and financial institutions. So there was a large sum of money that was pretty much getting fed back into the business. And after, I guess, earnings had already come through, because it's not for the business to, this cash that comes into the business doesn't, get held onto and retained by the business. It doesn't add to the bottom line, and it doesn't affect the free cash flow of the business at the end of the day. However, it is cash flowing through the business, hence why it's on the cash flow statement. So as they get more volume of payments, they've then got to, we're going to see these figures and the amount of money at a certain snapshot in time when this cash flow statement was done. They're going to have a certain amount of cash that's still coming in and through the business. So it was I guess these are net terms. So the overall value that changes to that cash flow. All right. So what I ended up doing was having a read through those. I ended up zeroing out these changes because at the end of the day, from what I could find, the cash that was coming in wasn't money that they had to effectively manage on their part of the balance sheet. It sounded like they get money from their transactions and they hold on to part of those payments until it's fully cleared and goes through. In a short version of it. So I decided to clear those out, and some of those were, positive, some were net negative changes on the income that came through the business before getting it down to this operational or cash from operations. So what it ended up coming out as, you can see it fluctuates a bit, 3%, 47%, 38%, then 8%. But overall, looking at the starting value of 551 million up to 1.245 billion, We had a 22% growth pretty much per year. Even though it's over that period, it's only really a 4-year period due to the start and end timeframes. However, that compounding's pretty good, and it's in line with the revenue, it's in line with the net income, and it also shows that the cash that the business actually then gets to respend, because it's money that the business has made and owns, can then be put to work within the business. So what did that end up meaning? So net margin didn't really change because we already had that. So the net income against the revenue is roughly around 44.6%. It's only really varied from 42 up to 47. So it's been pretty consistent over that 5-year period. It's not really trending down or up, which is nice. And now this is the owner cash. So what would usually be free cash flow is actually my adjustment here for the CapEx maintenance spend. So I want to be on the conservative side. So I've totaled up the capital expenditure that was put for capitalized software and intangibles, as well as any property, plant, equipment. Now, the majority of this is property, plant, and equipment. About over 95% of it is. And majority of that in the 2025 report, went to data center build outs and things like that. So increasing their network of, physical structure and assets. So really good. And we can see that's, less than 10% pretty much, or around that 10% figure of their free cash flow getting spent on growing that business. So not a huge amount. Owner cash, we ended up getting, that figure came out, and we're going to use that against our revenue, which is usually what a free cash flow to sales is. Just remember that's my version of it. We can see that it's had some fluctuations over that time. We had a big increase in CapEx here. We had a small increase here, and then that's filtered through to hit the bottom. So going down to 35%, but overall, without that little blip, it's around that 40, and even with it, it's around 46%. So that's really good. It's just business that's producing a lot of cash, I guess, for a small amount of revenue that it does make. Now, I did try and come up with a return on invested capital, but it's all over the shop. There's a couple of different ways to calculate it. I did have a crack at it, but the challenge is the business doesn't have really any debt. It's got some equity. I just did the last couple of years. And, come across with the income that we had, but the amount of cash that they have on hand is huge. So they've got just for, I guess, trying to maintain a really exceptional balance sheet so that they, I guess, as part of their trust with their vendors and, customers as well, to try and maintain that image and trust with them. They're trying to make sure that they've got huge amounts of cash that they will either put to work in the future or just maintain a significant amount of cash position. What that means is it makes it look pretty ordinary in terms of return on invested capital. Yeah, that's the challenge that we've got. If you guys, feel free to hit me up in the comments, have looked at the business yourself, done another teardown to have a look at another way to see with the money that they're reinvesting back within the business, if it comes out, in a more representative light. Because at the moment, a minus 17% return on capital doesn't really explain our 23% year-on-year free cash flow growth. If we're having challenges here over the long term, we'd be expecting this to decrease pretty quickly. But that's not the case. Now, the other one is the business 5 years ago had exceptionally high valuation. And so even using Buffett's old $1 of value for every $1 of retained earnings, well, the business has done pretty ordinary because it's pretty much flat. It's got, over that period, it's got roughly about $4.5 billion in retained earnings between 2021 and the end of 2020 up to 2025. And across that period, it's pretty much flat. So it doesn't meet that criteria. However, it was a pretty speculative stock back then. And really, the value we're looking at in 2025, the business is priced about the same as it was back in 2020, 2021. So it just shows that they had super high expectations. A lot of people are being burnt by the stock with those super high expectations of it. But she's been chugging along, and I'm expecting to find that the business is pretty undervalued and a pretty good potential opportunity. But I'm not going to bother doing the valuation and whatnot until we've completed our fundamental analysis. So let's crack into that. So what I want to do is I want to have a sticky beak, and today I'm not going to read through the whole report. We're going to have a look at and have a read of more of these. Who's the CEOs or co-CEOs we've got here, and go from there. Just a couple of bros just hanging out. All right. Enhance. All right. So it's always good to have a read through this, especially if you're going to do the deep dive on the business. Don't worry too much about like reading into it and putting a lot of weight behind it, but it's just a lot of data, lots of little data points. So we're proud of the progress we made in 2025 as we continue executing against our long-term vision. That's nice. So that's a plus side. Our focus remained consistent throughout the year, building a financial technology platform that enables our customers to operate with greater efficiency, resilience, and control as they scale globally. Okay. So consistency, focus, they're the kind of words that we want to put a big tick behind, and it's clear about their vision for how they want to try and help their customers. Macroeconomic, geopolitical developments in the first half reshape the operating environment, blah, blah, blah. Policy shifts, blah, blah, blah. We support our customers throughout these changes using a single platform. Without reworking their setup. All right. As AI continued to be a central topic within the financial services industry, our customers were highly engaged in understanding its potential impact on their businesses. Our approach remains grounded. We build with our customers in mind, and we apply AI where it meaningfully improves outcomes. All right. So they're being grounded and reserved. Yeah, that's good because we don't want to see people get shiny, especially the CEOs. So get shiny object, spur the business off into a completely different direction, and then it takes their eye off the prize for where they're actually delivering value to their customers. All right, by embedding intelligence directly into our infrastructure, rather than treating it as a standalone capability, we strengthen how payments, risk, and financial flows operate end to end. Okay, so an integrated solution. What else we got? This is AI is enabling a new level of performance across the platform. This is evident in the evolution of dynamic identification as our foundational layer. Built on our single stack and banking infrastructure, it draws on trillions of interactions across online and in-store commerce to inform decisions in real time. As fraud grows more sophisticated, dynamic identification allows us to move beyond static checks and instead balance security, conversion, and customer experience with greater precision, supporting safe, scalable commerce. All right, so kind of like it's not as clear as they could have been here, but pretty much, yeah, okay, so like they've got AI and they're using it to identify fraud in a way that is very efficient and, you know, has little to no impact end-to-end. The link between these foundational platform choices, measurable customer outcomes, is reflected in Adyen Uplift. So our AI or optimization product suite. So following a successful pilot, 2024, Adyen Uplift operated at scale for the first time in 2025. All right, that's good to know. Delivering immediate value across a broad customer base. Because it is embedded within our single platform, its impact compounds over time. Ooh. Baby, he's telling me all the things I want to hear. So seeing something that can be built once and then, you continually get the return from it is something really good. And it's what we should expect with a software-based business. With decision-making continuing to improve as more transactions flow through the system. Okay. So what's something to take note of there? They've got software solution. They distribute that. They then get feedback on it and improve it. Then what does that do? Bring more people in, and then the cycle repeats and it keeps optimizing. So that's a really, that's something we want to keep an eye on, but it's a really good positive sign. Its first year, Adyen Uplift reinforced our conviction that intelligence, when applied with discipline and control, consistently delivers stronger outcomes for our customers. All right. So yeah, that's good. This is also how we approach emerging models such as agentic commerce. While this evolution is unfolding gradually and we are starting to see the first transactions, we see it as a meaningful next phase in the digital commerce journey. What the hell does that mean, guys? All right. So with the research I've done, all the new buzz term agentic, which means, autonomous or autonomy, is just pretty much saying AI agents and things like that now have the approvals, from their users to start making payments on their behalf. So say I go out and I'm like, hey, hey Siri, can you go and order me a pizza? Well, Siri goes, hell yeah, brother. Blah, 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 goes and orders it, transacts between, and actually orders it, pays for it as well. This is what they're talking about. Specific types of these AI agents and stuff will start to use these payment systems, Visa, MasterCard, other ones like that, as well as Adyen. And how do these businesses look after fraud and fraud prevention and terrorism financing and things like that? And how does that interact with their model? How do these agents, do they need anything in particular to be able to transact more efficiently with these networks? So that's kind of what's going on. And most of the big players in the payments industry already have ways for them to be able to transact and work around that. All right. So we can expect that just to increase in the future. At this stage, I am not sure what efficiencies or, if it'll mean any form of, increase in productivity, or if it's just going to transfer transactions from people to people using AI to do those transactions for them. Will it actually be more money getting circulated? Probably not. So we'll go from there. All right, our focus is on building the infrastructure that allows customers to adopt these models at their own pace while maintaining ownership of their customer relationships, payments and data, and risk standards. We are extending our existing platform so that agent-initiated transactions can become another channel with established workflows, governed by the same principles of security, interoperability, and merchant control. All right. As our platform continues to evolve, people remain central to our progress. We trust our teams to take ownership, collaborate across disciplines and make informed decisions based on real-world customer needs. In 2025, this approach enabled us to scale deliberately, maintaining focus while continuing to move at speed. All right. So this is really important. So like, it's really good to read through an annual report and, a co-CEO or, a CEO letter to shareholders. And for instance, if you wanted to go through and you wanted to, like I'm kind of doing here, highlight positive, green flags, red flags of like the language and the type of language people are using. There's definitely things that are positive. So like that I'm seeing here. So focus, speed is incredibly important as well, because at the end of the day, you can have great product, but someone can innovate faster than you and they will take your market share. So even if you've got an exceptional moat around the business, if someone else has got more speed, they'll close that gap real quick. And so by going through that, we might read this and be like, yep, this is 100%, 100 out of 100, perfect CEO. But you've then got to look a bit deeper and see, did they actually say last year that what they would do, what they committed to? And, if you go back through Amazon's reports, it's pretty much, the same CEO letter every year talking about the same stuff that was there from the 1997 one. So it just shows that with focus, maintaining speed, you can really see these, things align. And sometimes the CEO might not be able to articulate, these good points. So it's not necessarily if you read it and it's all red flags or it's all just gobbledygook, it's like nothing. That doesn't mean it's a bad thing either. It might just mean old mate doesn't know what good looks like. These guys do. These investments, hang on, here we go. Maintaining focus while continuing to move at speed. We expanded our tech hubs around the world and continue to invest in local expertise across high potential markets. Local expertise, okay, so people, most likely, and our tech hubs. So like I said, about almost 100 million euro was spent on, majority of it was on data centers and things like that. So you said in tech hubs, he's talking about that. And what does that actually mean? That's their payments network. All right. So that's pretty cool. And like I said, they're making a shit ton of cash. So, I think it would be sick if these guys were investing faster, but it is what it is. Like Amazon had, what was it? A very small amount of cash flow because they pretty much get all their net operating income and then plow it straight into investments. It's, building sheds. So these guys could be doing the same thing, but at the moment they're trying to build their cash position. So anyway, alongside building for commerce, we continue to scale our impact through our pledge to dedicate 1% annual net revenue to causes aligned with the UN Sustainability Funds, blah, blah, blah. All right, yeah, cool. So like as an investor, yep, you do want there to be some form of, giving back. But at the end of the day, for our business analysis, like unless this goal is perfectly aligned with the business's mission, this is more like a little side quest, like a, yay, well done, give us some happy snaps. It's nice to see a business doing that, but like it doesn't. People don't directly go to Adyen and go, hey, they're making a huge difference because of this. I'm gonna, go and work with them. Kind of like the toilet paper brand. What is it? I think I've got a box around here. What's it called? Yeah, who gives a crap.org. Like, that's a mission where the majority of the, a large portion of what they make is dedicated to their mission. And so they're putting their proverbial nuts on the block, and then their customers can get involved and get behind what that mission is. So that's where I'd be keen on looking at this. It's like a tick box, but anyone can go out and do this. Terrible businesses, exceptional businesses, all can do something like this, just to, I guess, tick the box. But it's not essential. It's nice, but it's not really a point where, they don't win a point from me as an investor. Across every part of our business, our focus remains unchanged. That's what we want. Building for the needs of our customers. All right. So, one key thing, focus is everything. How many times have we continued to read focus here? And if they're trying to do that, they're trying to reinforce, if anything, to us as investors to say, hey, look, we haven't changed from our mission. We're still doing it from however long. This is going to continue to build, and there's going to be ups and downs. So if you guys, effectively want to stay and buy into that, like, they're trying to reinforce to us that, yes, they're still going. They haven't met challenges that are too big for them to face, and they're continuing to plow ahead through that. How are they doing that? Through platform intelligence, infrastructure decisions, and operational discipline. We continue to help them reach their ambitions faster. We're excited about the path ahead and the strength of our position as we continue building toward becoming one of the world's leading fintech platforms. Peter and Ingo. Cool, just a couple of bros. Just a couple of bros hanging out. All right. So, pretty boring for me to just continue to read all this. But things are like, if they've got their chief technology officer, like financial technology, fintech, financial technology business, understanding this guy, he's going to play a huge part in the business. So either have a look how, he's come about, what he's done before, things like that. And if there's anything written up on him, if he's gone and done some interviews and stuff like that, they're definitely parts of the business that you'd want to, learn a lot about. For instance, if this business's moat is, its brand, plus obviously the technology that's getting built behind it. So this guy is a huge key player alongside the CEOs. Now, if it was something like Nike, you'd want the chief marketing officer, because Nike is all about brand. And, similar to Apple back in the day, technology and brand. And so that's how those guys, like, you've got the CEO, but you'd really want to dive into what are those guys talking about? What are they focusing on? So I'm going to continue on with this. I should be pretty close or concluding the review of the business by tomorrow, with the other reports that I've been through already. And yeah, should be adding to that and doing some form of evaluation of it either tomorrow or the next day. So if you're interested in that, feel free to subscribe or just check in on that one. And otherwise, was there anything else from this? No, yeah, well, like I said, if you guys have had a look at Adyen yourselves, know another way of checking out what kind of returns we, invested capital returns. There's probably another way I could do it from having a look at their investments from assets in terms of the physical assets that they're putting in place and go from there. But otherwise, thank you, and I'll catch you.